The stock market is a public marketplace where ownership in various businesses is bought and sold by everyday people and large institutions. The reason this market exists is to serve as a vital bridge connecting companies that need capital to innovate with individual investors who want their savings to grow through the success of those companies. For example, when you buy a share of a technology giant like Apple or a retail leader like Walmart, you are effectively providing them with capital while securing a legal claim to a piece of their future profits and physical assets. This transformation is powerful because it allows you to stop being just a consumer of products and start being an owner of the productive engines that drive the global economy. By participating in this market, you are positioning your wealth to benefit from the collective work and innovation of thousands of employees around the world. Owning a stock means you possess a fractional piece of a real-world corporation with all the rights that come with it. This ownership is significant because it grants you a claim to the company earnings, and sometimes even a voice in how the business is managed through voting rights on major corporate decisions. Imagine a massive pizza cut into millions of tiny slices where each slice represents one share of the total business. If the pizza grows in size because the company is doing well, your individual slice becomes more valuable, even though you only own a tiny portion of the whole. Realizing that stocks represent tangible ownership in physical assets, brand names, and intellectual property helps you move away from seeing blinking numbers on a screen. Instead, you begin to see real business value, which is the first step toward becoming a disciplined and successful long-term investor in the financial markets. The stock exchange is the central infrastructure that facilitates the secure buying and selling of these corporate shares between participants. Without a regulated and centralized exchange, like the New York Stock Exchange or the NASDAQ, it would be incredibly difficult for buyers and sellers to find each other and agree on a fair price for any given company. Think of the exchange as a high-tech digital matchmaking service that processes millions of trade requests every second to ensure that when you want to sell a share, there is a buyer ready to take it at the current market value. This high level of liquidity and constant regulation provides the security and transparency necessary for you to invest your hard-earned money without fear of the system itself failing. By using these exchanges, you gain access to a transparent pricing mechanism that ensures you are always getting the most current and fair market price for your investments. An initial public offering, or IPO, is the specific process by which a private company first offers its shares to the general public. Companies choose to go public because they need to raise significant amounts of money to expand their operations, pay off debts, or fund new research and development that would be impossible with private funding alone. A famous example of this was when Amazon went public in the late 90s, which allowed them to raise the cash needed to transform from a simple online bookstore into the global logistics and cloud computing giant they are today. Understanding the IPO process helps you see the life cycle of a business and the moment it transitions from being owned by a few founders to being owned by the public. This transition is the moment when ordinary investors like you finally get the opportunity to participate in the future growth and potential of that specific business. The power of compound interest is the primary reason why the stock market is such an effective tool for long-term wealth creation. Compounding works because when your investments grow, the gains themselves start to earn their own gains in a snowball effect that accelerates over many years or decades. If you invest $10,000 and it grows by 10% in 1 year, you have $1,000 in profit. The next year, that 10% growth applies to the new total of $11,000, meaning you earn $1,100 instead of just $1,000. Over a period of 30 or 40 years, this mathematical reality can turn modest monthly contributions into a substantial fortune that provides for your retirement. This proves that the amount of time you spend in the market is much more important than trying to perfectly time the exact moment you buy or sell a specific stock. Risk is an inherent part of the stock market that investors must understand and manage to be successful over the long term. This risk exists because the value of a company can fluctuate based on economic conditions, poor management decisions, or changes in consumer preferences that are often unpredictable. For instance, a company that makes traditional film cameras might see its stock price plummet when digital smartphones become the primary way people take photos, causing investors to lose money if they did not adapt. While the possibility of loss can be intimidating, it is the very reason why the potential for high returns exists in the first place. By acknowledging that prices will move up and down in the short term, you can develop the emotional discipline needed to stay invested during downturns and wait for the eventual recovery of the broader economy. Diversification is the most effective strategy for managing risk by spreading your investments across many different companies and industries. The reason this strategy is so essential is that it prevents a single bad event at one company from destroying your entire financial portfolio and your future savings. Instead of putting all your money into one single airline stock, you might choose to own shares in technology companies, healthcare providers, energy firms, and consumer goods manufacturers simultaneously. This way, if the airline industry struggles due to rising fuel costs, your gains in the technology or healthcare sectors can help offset those losses and keep your total portfolio balance stable. Diversification ensures that you are betting on the growth of the entire global economy rather than gambling on the success or failure of just one or two specific businesses. Dividend investing is a popular method for generating passive income, where companies share a portion of their profits directly with their shareholders on a regular basis. Many established and profitable companies choose to pay dividends because they have more cash than they need for immediate growth and want to reward their loyal investors for holding their stock. For example, a utility company that provides electricity to a city might pay a quarterly dividend, giving you a steady stream of cash into your brokerage account regardless of whether the stock price went up or down that month. This income can be used to pay for your living expenses, or it can be reinvested to buy even more shares of the company, which further accelerates the compounding process. Focusing on dividends allows you to see your portfolio as a collection of income-producing assets that provide tangible cash flow throughout your entire life. Growth stocks represent companies that are expected to increase their earnings at a much faster rate than the rest of the market. Investors buy these stocks because they are looking for significant capital appreciation, even if the company does not currently pay a dividend or show a large profit today. A classic example would be a young biotech company developing a revolutionary new medicine. The stock might be volatile and risky, but if the medicine is successful, the value of the company could multiply many times over in a very short period. While these investments carry higher risk than established blue-chip companies, they provide the necessary engine for outsized gains in a modern investment portfolio. By including a portion of growth stocks in your strategy, you are giving yourself the chance to benefit from the next generation of industry leaders and technological breakthroughs. Index funds and exchange-traded funds, or ETFs, are investment vehicles that allow you to buy hundreds or even thousands of stocks in a single transaction. These funds are popular because they offer instant diversification and professional management at a very low cost, making them perfect for beginners who do not have the time to research individual companies. When you buy an S&P 500 index fund, you are effectively buying a small piece of the 500 largest and most successful companies in the United States all at once. This approach removes the stress of trying to pick the single best stock and instead allows you to simply capture the overall growth of the entire market over time. Using index funds is often considered the most reliable way for the average person to build wealth because it minimizes fees and guarantees that you will participate in the market long-term success. Market volatility refers to the frequent and sometimes large price swings that occur in the stock market over short periods of time. This volatility is driven by human emotions like fear and greed, as well as by the constant flow of new information that investors are trying to interpret every day. During a market correction, you might see the value of your portfolio drop by 10 or 20% in a few weeks, which can feel very scary if you are focused on the short-term numbers. However, historical data shows that the market has always recovered from these temporary drops and gone on to reach new all-time highs as companies continue to innovate and grow. Understanding that volatility is a normal and expected part of the investing journey helps you avoid making impulsive decisions based on temporary panic. By maintaining a long-term perspective, you can view market drops as opportunities to buy high-quality assets at a discounted price. To actually start your journey, you must open a brokerage account, which is a specialized financial account that gives you access to the stock exchanges. This step is crucial because it serves as the portal through which you transfer money from your bank and use it to purchase shares of stocks or funds. Most modern brokerages now offer user-friendly mobile apps and have eliminated trading commissions, meaning you can start investing with as little as $1 in some cases. Starting early, even with a small amount of money, is the best way to take advantage of the time and compounding required to build a secure financial future. For instance, once you fund your account, you can search for a ticker symbol, decide how many shares you want to buy, and execute the trade with just a few clicks on your phone. In this guide, we have covered the fundamental concepts of ownership, the role of the exchange, the power of compounding, and the importance of diversification through index funds. We have seen that while the stock market involves risk and volatility, it remains one of the greatest tools in history for generating long-term wealth and financial independence. The key to success is to start as soon as possible, stay diversified, and maintain a disciplined mindset even when the market feels uncertain. If you found this deep dive into the stock market helpful, please make sure to like this video and subscribe to the channel for more educational finance content. We want to hear from you, so please leave a comment below telling us which specific stock or index fund you are thinking about adding to your portfolio first. Thank you for watching, and remember that the best time to start building your financial future is today.